Hello all, welcome to our platform for investor education. In this module, we'll be talking about aspects of share trading. In India, the notion of investing has come to mean that you put your money in fixed deposits or even gold. For the most of us, the wealthier amongst us do, however, dabble in more complicated financial instruments like stocks in share markets. When you buy shares in a company, you're really buying a portion of the business. If the business prospers, the value of shares in the company will rise. Of course, by buying shares in this business, you're exposed to a risk that the business activity fails to generate the kind of profit that is expected. In contrast to investing, the notion of trading is when you buy and sell something in a relatively small span of time, hopefully at a profit. Share markets let investors buy and sell shares on as large or as small a scale as they desire. Some might buy them for a short time, a few minutes, an hour. Others for a week or a month. Still others may have a longer horizon. Before understanding how share markets work, let us first look at transactions in markets that are already familiar to most of us. Example 1. Mr. A has a cycle or scooter or car to sell, for which he places an advertisement in a newspaper. In the advertisement, he mentions an acceptable price range and his contact details. Interested buyers might contact him to negotiate the final price and close the transaction. No middlemen are involved. Example 2. When we go to a market to buy groceries, say tomatoes, we may directly accept a price or bargain with the seller to get a better price. Here, there is a common physical location. Example 3. When you purchase real estate through a second sale, there is typically a broker, middleman, who shows you different properties, and there is also a bank from whom you may borrow a large portion of the money needed to pay for the purchase of that real estate property. In the examples above of common transactions you may have engaged in, the common thread is that one person, the seller, has something that the other person, the buyer, wants. Who the buyer is and who the seller is very clear. Let us dig into the grocery scenario a little more. The vegetable seller on your street probably purchased the tomatoes early that morning from a wholesaler and is looking to sell them to you for a higher price. You can think of the price you pay as a retail price. But look again at the wholesaler now. This person probably has many farmers selling him tomatoes early in that morning. As long as he or she can buy tomatoes from the farmers at a lower price and sell them to the street vendor at a higher price, he will do business. This is how the wholesaler makes a profit. If, over the course of the day, tomatoes are sold at a higher price than the purchased price. Buying here amounts to increasing the inventory, and selling amounts to reducing it. What may cause prices to change through the day? If there is a bumper crop of tomatoes, for instance, and there are many farmers wishing to sell tomatoes, the price will obviously fall. Likewise, if there is a drought and the supply of tomatoes is less, then the tomato price will rise. This simple demand and supply idea are the very basis of market activity. The reward for the wholesaler is for making a market, in tomatoes in this case, and the profit accrues from facilitating that market activity. When we compare this example to a share market, one difference, of course, is that shares do not spoil like tomatoes. Another, that transactions do not happen only early in the day, but throughout that day. The price at which the market maker is willing to buy is called the bid price. The price at which he is willing to sell is the offer or ask price. The quantity which he intends to buy or sell is referred to as the depth. But that is not all. Money and shares are changing hands. Both banks and record keeping is involved. So there are middlemen as well. The reason for prices to change is also more complex than the simple supply-demand story we told regarding the wholesaler. The cost of making the things the business sells may go up or down. If there is a shortage of tomatoes, the cost of raw material for a company that makes tomato ketchup will come down. The company's officers may retire, they may make good or bad business decisions, they may even be caught for illegal activities. In summary, the location for all share market transactions is mostly electronic. Trading is not time-bound. You can pick any time of the day. Some market is open somewhere in the world for trading. The buyers and sellers are mostly active and changing prices in response to news and market conditions as they evolve. The transaction almost always involves an organization interposing between the transacting parties. An organization termed as the clearinghouse verifies the parties and arranges for transfer of money and of shares and charges a clearing fee as its commission. This process, where the actual delivery of funds and transfer of securities occurs, is called settlement. The clearinghouse follows a T plus 2 day settlement cycle where T refers to the day of the trade. The involvement of clearinghouses makes this process of share trading extremely reliable and free of concern for the involved parties. The Bombay Stock Exchange and the National Stock Exchange ensure that this process is completely transparent. The Securities and Exchange Board of India, SEBI, regulates the activities and prescribes the rules of market players for orderly operations. In conclusion, trading in share markets is more complex than the simple transactions that we engage in from day to day. However, understanding the nature of market conditions is going to make you a much better investor. Remember, as a smart investor, you have to set your moves very carefully.